Alright, time to level up, gentlemen. In this second episode of how to accurately sell options for income, we're going to explore another real-life trade example, but unlike in episode 1, this time we'll be forced to deal with how the underlying stock behaves when pushed to the brink. That is, when the option position is on the verge of going in the money. Let's get it. So let's focus today on a real-life option trade that I executed on MGM on September 22nd, 2023, right after the hack that created chaos for days in the operations of the casino giant. The stock was obviously under stress, which is what we want. I went ahead and applied the exact same 5 criteria for opening a position that we used in episode 1. That is, determining the implied volatility triggers, analyzing extreme historical deviations to minimize tail risk, short-term trade timing optimization, strike adjustment using OIBs, and solving option parameters for best flat and annualized yields. This led me to sell a put strike $34 with a maturity of November 17th, 2023, or 56 days out. I collected $1.07 per share, which was equivalent to 3.1% flat or 22.3% annualized. Now this is where it gets interesting. At a reference spot price of $36.54 at the close on the day of the option trade, the entry timing was obviously not perfect. It never will be. But once again, it was pretty damn accurate. Over the following 2 weeks or so, the stock price kept dipping and all the way down to $34.49. That is 49 cents shy of our strike. As predicted by the options dragnet framework, this level held up and sent the stock back up all the way to $38.25. That is before yet another dip happened, this time to $34.12. The strike level resisted yet again and sent the stock flying, never to be seen again in this area until option maturity. The reason why this observation is important is because it demonstrates how powerful the framework is at identifying solid strike levels. When paired with a realistic modeling of volatility, both implied and historical, the open interest bottlenecks that we overlay on top of this quantitative analysis drastically reduce the risk associated with these trades. So where is the added difficulty compared to the previous trade that we reviewed and was on easy mode? After all, this trade on MGM also somehow took care of itself and ended up in a profit without much effort, as did our trade on Tesla options. Well, yes, it did, except this time we had to actually cut this one early before expiry date. Why? Because MGM had an earnings release set on November the 8th after the close or 9 days prior to expiry. As with the rest of the framework spirit, we're looking to cut tail risk as much as possible, since tail risk is the Achilles heel of short option strategies. Obviously, we're not going to do it at any cost, but the framework introduces a quantified threshold past which it becomes more advantageous to cut the trade instead of running the risk to go through a bad earnings release. That is because at this point, the bulk of the option's value is made up of its vega, while the theta is already near collapsed. In this case, on November the 8th at the open, we bought back the put at 10 cents and took profit early, right before the earnings call that took place after the close. As it turns out, and as you can see, this trade was unnecessary because the stock kept running up after it. However, you can see how much the stock seesawed after the earnings release, and it could have been just as volatile to the downside. So, whenever your position is coming up to a high volatility event like this one, gambling for the remaining pennies on the dollar left in your option contract simply is not worth the risk, and it might be to your advantage to take profit early. So, to summarize, on easy mode, we saw how a short option trade can run to completion without having to intervene until maturity. In this episode, though, on intermediate mode, we saw that sometimes manual intervention and early profit taking might be required when a big volatility spike is anticipated and there is substantial profit to be taken. The framework provides a quantitative criterion for it. In the next episode, on hard mode, we'll be looking at a much more convoluted trade where deep risk management becomes required after the option closes in the money and the underlying stock gets assigned to us. I will be showing you when and how to pull a recovery trade using covered calls, and especially when to bail and take a loss. This will be in the next one. So until then, I want you to make sure that you're grasping all the concepts and the steps in the decision tree of the options dragnet framework that we have described so far. The next episode will compile all of them and will be much more complicated. I'll catch you all then.